Podcasts on UNC-TV.org are made possible through the financial contributions of viewers like you, who invite you to join them in supporting UNC-TV.
You read of banks modifying struggling homeowners' mortgage terms and government programs offering financial assistance to keep some borrowers from losing their homes. In policy circles, you'll hear a debate over whether these well-meaning programs are any good for our economy. It's called the moral hazard. What is a moral hazard?
Jeff Foxworthy actually has a routine about it. He talks about how whenever he goes to get a rental car, he buys the full coverage insurance, everything. You wreck the car, no matter what it is, you just walk away, you get in another one. He says, because when I do that, I can drive like a wild man.
Moral hazard suggests that borrowers who sign for unaffordable mortgages will act irresponsibly in the future because they are bailed out through a loan modification. The North Carolina Justice Center's Rochelle Sparko helps homeowners fight foreclosure. She says some borrowers might have been negligent, but not all borrowers facing foreclosure. Is it really a moral hazard to help the little guy?
I don't think so. I mean, I appreciate that there are probably two distinct groups of people here, but what we've been seeing over the last couple of years as we try to figure out how to mitigate the crisis is that there's no good policy decision that anybody's been able to put forward that helps us to distinguish between the two groups.
Dr. William Hall is an economics professor at the University of North Carolina at Wilmington.
We began with a proposition or an hypothesis that if you reduce the penalty for engaging in a particular act, you take away some of the risk that the individual who engages in that act might bear, that you've reduced the cost of engaging in that act.
I just have a very hard time saying, let's just take a position of not helping anybody because some people knew what they were doing. There were so many people who didn't, and a lot of those people were lower income borrowers who stand to lose everything.
The John Locke Foundation's Dr. Roy Cordado draws a distinction in classifying an anti-foreclosure effort as fueling the moral hazard. Neighbor A receives a mortgage modification because they can't afford the mortgage. What lesson do they learn if someone steps in, modifies that mortgage to keep them in their home and keep them making the payment at a reduced level?
Well, it depends on who that someone is. If it's the government saying we're going to do that with taxpayer-backed money, that's one thing, and I would argue that shouldn't be done. If the bank looks at that situation and says, well, it makes more sense for us to modify that loan, restructure it, and keep them there than it does to foreclose on them, then that is I would argue, a decision that makes sense.
A private decision.
Right, a private decision right.
But neighbor B over here has cut off the cable, sold the new car, got an old clunker.
Mm-hmm.
They're scraping by to make that house payment,
right,
and don't want the mortgage modification. What do you say to them if that happens next door?
I'd say to them, look, this is a private contractual relationship between your neighbor and their bank. If your bank isn't willing to make that same arrangement, well, you know, maybe you negotiated with the wrong bank. I don't know what their particular situation is. But how much worse would it be if you said to that person, I am going to tax you. You are responsible. You are making your payments. You're doing what you have to do. And I am going to tax you and take that money and bail out your neighbor with essentially your money. I mean, that is the true injustice.
Supporters of mortgage assistance programs say it's impossible to separate purposely negligent borrowers from those borrowers affected by unforeseen circumstances, like a job layoff.
Most of the people who are getting loan modifications, they've done everything they need to do. I mean, most of these folks, they're not hanging on to a lot of assets. They have run themselves down to where they have no choice left. So I think in the majority of people we talk to who are seeking modifications, it's not so that they can shield other assets. It's because this is as far as they can get.
Do you think people who face adverse situations, like the topic we're speaking, they don't learn their lesson? Or they do learn their lesson?
I think they do. I think people learn. Look, you know, if they didn't, then I would argue markets don't work, because markets are all about trial and error. People make mistakes in markets. Businesses make mistakes. They make investments that go south, And if they don't get bailed out, they take the losses, learn their lessons, and change their investment strategies.
Will lessons get learned by this? Are you seeing people who are saying, okay, I won't make this mistake again, or are you seeing people who go, haha, got away with it, I get to stay in my house?
Nobody I have worked with has said, haha, I've gotten away with it. I mean, nobody's getting a free house. Nobody's getting away with more than they should. I think, there is no principal reduction that's happening. We wish that it were.
I think people learn, but they don't learn if you don't give them an incentive to learn. In other words, what encourages the learning process is bearing the costs.
There are consumer advocates out there who say borrowers didn't know what they were getting into. They just wanted a home. They acted in good faith, and they were taken advantage of. You buy it?
It's possible to some degree that's true. On the other hand, it's rather paternalistic, if you ask me. It says, well, these people are stupid, the banks are smart, and people just went out and got loans that they couldn't afford.
You could complain about it and maybe feel angry that your neighbor got an interest rate reduction, but all that's doing is reducing the amount of money that the bank is making on the property. It's not reducing the amount of money that the people borrowed or the amount that they're paying back, at least from a principal perspective. What we're also seeing a lot of times is a reamortization of the loan, which means they're recalculating for how many years a borrower is going to have to make payments. So it just means they're not going to own their home in 30 years, they're going to own it in 40.
If there is a moral hazard to helping homeowners who face foreclosure, consumer advocates say there are equal hazards for neighbors whose properties can lose value should an empty home go to foreclosure auction.
The average North Carolinian who lives a quarter mile from a foreclosed house has seen their house depreciate by up to $2,500. If you live with a lot of foreclosures, you're taking a beating even though you did everything right.
What you're seeing is, by helping an individual, you're seeing an entire community, entire neighborhoods being preserved, at least from a property value standpoint.
From a property value standpoint, from a safety standpoint, having a vacant property next door is, it's a danger. It's a danger to the community.
Someone may very well be happy about the fact that their neighbor got that bailout because of it, but it doesn't change the argument that when you do that, it also increases the possibility and the probability that other people going into markets to borrow money are going to take, because they think, well, okay, so if I can't pay the payments, I'll get bailed out too.
North Carolina qualified in spring 2010 for federal funding to cover zero-interest loans that will make the mortgage payments for borrowers seeking work, job training, or facing qualifying and temporary hardships. Over 400 borrowers could see the principal on their mortgages reduced or their interest rate permanently lowered. The discussion on whether bailouts like these or empty houses are the greater economic risk will continue.